Okay, hi there. Welcome to a short video looking at the concept of the bond yield curve. So bonds are forms of debt. They're securities issued by governments, companies and banks in order to raise fresh extra finance. Typically bonds don't confer any share of ownership of a company in contrast to equities or shares. Government bonds normally carry a fixed amount of interest paid every 6 months or every year, and the interest is known as the coupon. And bonds have a fixed redemption value, so when a bond matures, when the bond reaches the end of its issue, it's redeemed, well hopefully repaid, at a predetermined par value. So a £1,000 bond, say issued in 2020, might be repaid £100,000 in 2022 if it's a 2-year bond. Now in the UK, government issued bonds issued to help finance a fiscal deficit, well they're known as gilt-edged securities, and the secondary market where you can buy and sell bonds once they've been issued is called the gilts market. If we think about the composition of UK government debt at the end of 2020, you can see here that most government debt, 28%, is between 0 and 7 years, short gilts. 24%, about a quarter, is 15 years or more. Index-linked gilts are gilts where the rate of interest tracks the rate of inflation to protect the real value. And about 10% of government bonds are in the form of national savings and investments, including, for example, premium bonds. So, what is a yield curve? Well, the yield curve is essentially a way of comparing rates of return or percentage returns on bonds of differing maturity. We'll have a look at the yield curve for the UK in a second. Normally we'd expect the yield or the interest on a bond for long-dated bonds to be higher than for short-dated securities, because if you're buying a government bond for let's say 10 years, you're lending the government money for a decade, then there are quite significant risks going forward, in particular the risks of inflation. So what does the yield curve look like for the UK economy? Well, this data is for September 21. And a yield curve is a line that plots the yield or the interest rates of bonds that have equal credit quality but different maturity dates. So take a look at the x-axis first of all. You can see here that our bonds are varying from 6 months, they're repaid within a year, to 1 to 2 to 3 to 5 years going forward. And the bond yield indicates the level of return in percentage terms that the investor can expect from a given type of bond. Short bonds have a redemption date of less than 5 years, so 6 months through to 3 years. Medium dated bonds have a life of over 15 years, have a life of 5 to 15 years. So the government might borrow, for example, in 2021 and repay in 2031 on a 10-year debt. And long-dated bonds have lives of over 15 years. And I've plotted 3 of them here for the UK: a 20-year bond, a 30-year bond and a 40-year bond. I mean, some bonds are actually undated. War loan, for example, and they're called irredeemable bonds. They're not repaid, but they just pay interest to the holder. Now, the slope of this yield curve gives an idea of future interest rate changes in economic activity. Typically, when you're borrowing for longer periods of time, you'll have to pay a higher rate of interest on those bonds. You see, the investors, the potential buyers of your bonds, they're carrying some of the risk if they lend to you. So the longer they're lending to you, normally the higher the rate of interest that they should be rewarded with. This balance between risk and reward. And you can see for the UK that indeed the bond yield curve does rise as we go from short-dated bonds to medium bonds to a peak of 1.77% for a 10-year bond. However, at the moment, the yields on even longer-dated securities are very low indeed. The bond curve is inverting. It's starting to fall. This is quite interesting. This perhaps says something about the future growth and inflation prospects for the UK economy, that investors 30, 40 years ahead are prepared to buy bonds with a yield of 1% or less. It's useful to understand the significance of changes in bond yields. So when the borrowing costs for government are low, well, this might encourage them to run a bigger fiscal deficit, perhaps as a way of funding infrastructure spending, maybe as part of their green stimulus package or necessary investment to adapt to and respond to the threats from climate change. As you've seen from the previous chart, bond yields in the UK are very low at the moment, but they don't necessarily have to remain at that low level. Indeed, if bond yields rise across the yield curve, this will make it more expensive for the government to borrow money. And even a 1% change in bond yields across the curve can add many billions to the annual debt interest bill that a government must face. Let's take a look across the Atlantic. What does the yield curve look like for the US economy? Does it have a similar look and feel? Well, here it is. And we've got some short bonds there, 1 month, 2 month, 3 month, 6 month, etc. And then all the way through to 20 and 30-year bonds. So this represents in many ways a standard yield curve where bonds of longer maturity, 10, 20, 30 years, provide a higher yield. And that's essentially, again, just to explain, rewarding investors for the uncertainty around the condition of economic performance and financial markets in the future. But bond yields, again, this follows a typical sort of increasing bond yield curve as we head out into the further distance. But again, there's no certainty about bond yields, and many people are now starting to ask this question: will bond yields start to rise soon in the UK and the United States? Well, let's have a look at the rate of inflation in the United States, shown in this chart. The highest rate for 30 years, the current actual rate of inflation 6.2%. If we take a 3-year average, now heading up towards 3% for the consumer price index. Now, bond investors fear rising inflation because, if you think about it, if you're borrowing money for a long period, lending money for a long period of time, inflation reduces, erodes the value of the fixed interest payments that you're going to get on a government bond. So in turn, rising bond yields prompts other people to think about what they should be paying for their equities, for example, as well. Inflation in the UK is surging, and we can expect bond yields in the United States to start rising across the curve. A key question is whether this jump in consumer prices is transitory or more longer lasting. And finally, just a quick look at bond yields across different countries. This is just purely for 10-year debt. And you can see that bond yields are very low at the moment for many, many countries. These are typically high-income countries inside the European Union or the OECD. Indeed, in some countries, the bond yield is actually negative. Investors are prepared essentially to pay such a high price for these bonds that the rate of return they get, the yield on the bond, is negative. It's essentially a form of insurance against uncertainty in the future. So for the moment, bond yields remain low, but I think as we go into 2022, it's worth looking at the yield curves, looking at average yields, average bond yields across a different range of countries. These are likely to change as inflation starts rising in many countries. There we go. Thank you for joining in this short video on the economics of the bond yield curve.